Welcome to the Performance Measurement and Management module. Now, virtually since organisations began, they have had to somehow gauge their performance, and over the last 20 years or so there's been more and more attention paid to performance measurement and performance measurement systems, and there are lots of new ideas out there how to measure performance. I think the main reason for this is increasing competition puts more and more pressure on organisations, and so the performance measurement systems have to become more sophisticated. Now, one of the ways they need to get more sophisticated is in measuring people performance, and that's really what this module is here to address. One approach to performance measurement, which has become quite popular over recent years, is the concept of the balanced scorecard, or the balanced business scorecard. This idea has been around for many, many years in academia, because there is a lot of research that tells us that if you take a longitudinal study of organisational performance, you find some very successful organisations reach a point where they drop off over the edge of a cliff. Classic example of this was Marks and Spencer's about 10 years ago, when their profits went from £1 billion a year to about £500 million a year almost overnight, because they completely lost sight of what their customers really wanted. And academics have looked at this phenomenon and tried to find out what causes it. And in very simple terms, the conclusion is you cannot just run an organisation indefinitely by just looking at the financials, by just looking at profit and loss. You have to look at other dimensions, and you have to look at all of them together in a balanced way. This is a much more mature, sophisticated way of viewing organisational performance systems. This is the Performance Measurement and Management module, and if there is one thing that the professional HR or learning person can bring to an organisation, it's professionalism in performance management, adding some value to what the organisation and line managers already do. So what do most organisations already do? Well, quite a few of them use a thing called a balanced scorecard, so that's the first area we're going to look at. Other organisations follow the EFQM, the European Quality Model. So we'll have a look at that as well. But then we'll start to look at what added value really means, and how you measure added value, and how we distinguish that from other types of organisational performance measures. And finally we'll look at a performance management system and the key components of what that system might actually look like. This is a version of what is known as the balanced scorecard, or the balanced business scorecard. This one has been adapted from Kaplan and Norton, probably two of the most well-known proponents of balanced scorecards. What the balanced scorecard tells us is that an organisation that wants to measure and manage its performance has to look at a range of measures that all balance with each other. It cannot just look at profit and loss. However, one of the key boxes used on the balanced scorecard is the financial perspective. In other words, the finances will always have to be managed well, otherwise no organisation is going to survive. But that is not the be-all and end-all of performance management. An organisation should constantly consider its internal efficiency, because its competitors might become more efficient than it is currently, and if it doesn't keep up with the competitors, it's going to go out of business in the longer term. It should also keep an eye on its customers and fully listen to its customers and try and anticipate what they're going to want in the future, so it has to measure how well it's treating customers. And according to Kaplan and Norton and most other proponents of balanced scorecards, there is another box which Kaplan and Norton tend to call innovation and growth, but we're going to call it innovation and learning here. But most people regard it as the people perspective, or the people box. This should have a series of measures which tells us how well the organisation is managing its people. One interesting aspect of this is if you read Kaplan and Norton's work, they will tell you that of all the organisations they've worked with, the box that gets the least attention, the box that most organisations find very troublesome, is the people measurement box. But what is even more interesting is nobody suggests that that means that the balanced scorecard doesn't currently work. and yet you cannot have a 3/4 balanced scorecard. The whole idea is it's a holistic concept, and all four of these perspectives have to work in harmony if they are to work together at all. So the balanced scorecard is meant to be an intelligent answer to the problem of what range of measures do we need to really gauge sustainable performance in organisations. And although it takes into account people data, people measures, that people are important, that's what the balanced scorecard actually tells us. In effect, it is really just like another accountant's tool, because each of these boxes is expected to have a lot of measures in. Measurement almost becomes the goal, when in fact measurement is only a means to an end. And in fact, if you measure everything that moves, it can create a lot of cost. It can be very bureaucratic. It can be self-defeating. Why don't we actually look at the people dimension from a totally different perspective and say, hey, if we've got people who want to work here, if they trust us and we trust them, then the chances are they're going to perform. So maybe the balanced scorecard is a sledgehammer to crack a nut, and maybe it doesn't even crack the nut. Now let's look at another model, the European quality model, and see if that comes up with any better answers. Here is a model known as the European quality model, or the European excellence model, which is governed by the European Foundation for Quality Management, the EFQM, and it's been around now for some years. One of the big differences between the EFQM model and models like the Balanced Business Scorecard is this definitely, consciously, has a social dimension to it. So let's look at the component parts. First component is the left-hand side of this model have to be the enablers. We have to put things in place that enable an organisation to strive for excellence. And then we can look at the results. There is a loop here, an innovation and learning loop, just as with the normal balanced scorecard. And it says whatever results we get, we need to feed that back into the organisation to then use that as a basis for further improvement. And if we're getting poor results, then we need to think again about what we're doing as an organisation. So intrinsic to the FQM model is a learning model as well. Probably one of the most important of the enablers is clear leadership in an organisation. I don't think we need to challenge that. And obviously at the end of the day, the thing that really matters are key performance results. If we get good leadership and if we get the results that we want to get, then the organisation could be deemed to be performing well. Now, funnily enough, in the EFQM model, people are put very much at the top of the list, both in terms of enablers and also in terms of results. So making sure we have the right people doing the right things and looking at the results of how we manage people are key to the EFQM model. Of course, any organisation has to develop strategies and policies, and they also have to work with partnerships and manage their resources and their supply chain well. So all of these are key ingredients of any management model, regardless of on what basis it is formed. Obviously, as with the balanced scorecard, customer results are very, very important. In other words, keeping the customer happy is as important as looking just at profit and loss. But here in the EFQM model, there is a perspective or a box for society or societal results. The EFQM is definitely a social democratic model of organisational management and performance. Basically, it says if society at large is not satisfied by this organisation and it's not damaged in any way by environmental concerns or matters like that, then you cannot say it is a high-performing or an excellent organisation. It must take into account its impact on society. And in the middle of all of this are the key processes that the organisation has to use to make sure that its enablers turn into the sort of results that it needs. So this is another standard, well-used business model based on the idea that you have to balance all sorts of competing and potentially conflicting factors. I think the European quality model is a very ambitious model. It's a very sophisticated model, maybe too sophisticated. But it is definitely a departure from a typical commercial balance scorecard. I think if you read Kaplan and Norton's work, they are thinking of a capitalist system. And in Europe, we tend to have a more social democratic system. We think more about the social issues whilst we're running our organisations, or at least we're expected to. So looking at the people dimension and the societal dimension is absolutely crucial in the European quality model. That brings us around to the question of, really, what's the ultimate goal of organisations based on any of these models? There's a very simple answer to that question, and that is, what value does the organisation want to create? And what values does the organisation want to have? But let's deal with the first part of that, which is, what does value really mean in organisational performance management terms? We're going to do this by looking at a very small fictitious company called Double Glazing R Us. Now let us look at a particular company in some detail in terms of what sort of performance management system it might want to introduce. This is a company called Double Glazing R Us. It only employs 3 people, a phone canvasser who rings people up usually in the evening and asks them if they are interested in double glazing. They hopefully fix an appointment for a salesperson to go and visit the prospective customer, and assuming they sell them some double glazing, the fitter turns up and actually fits the double glazing. And we ask ourselves the question, what sort of performance system would you want to put into an organisation like this? Let's have a look at what double glazing's been doing. The first measure they're going to use is for the phone canvasser, and the managing director says you have to make 100 calls a day. That is a performance indicator. From these 100 calls, we need you to get 10% of those turned into sales appointments for the salesperson. So now there are 2 measures, the number of calls you make and how successful you are at creating the leads for the salesperson. As with most performance systems, this starts a cascade. So now the salesperson has to go and make these 10 sales visits for every 100 calls that the phone canvasser has made. So we're going to have some performance measures for the salesperson of the number of visits they make on average every day. And again, we want them to convert 10% of the visits they make into actual sales in terms of volume and value, in this case euros. Now the business is built up on the basis that it needs an average contract value of 3,000 euros, and all the accounts will be structured around this. So the fitter is expected to fit 3,000 euros worth of double glazing every day. And the fitter will be measured in terms of how long it takes them to do this and whether there are any faults or repairs that they have to make afterwards. So we want to keep the after sales costs down. Now if we take the total cost of producing the actual double glazing windows themselves and say they cost 2,400 euros, it would leave a gross profit of 600 euros, of which the company is going to pay each of the workers 100 euros a day, which would leave a net profit of 300 euros for the person who runs the business. We could also express this as net added value per person of 100 euros. So 3 people producing a net profit of 300 euros. If we divide that by the 3, it means they all add 100 euros. Now what happens if the cost of producing the double glazing goes up to 2,700 euros? Let's assume that oil prices rise and so the UPVC made for the windows costs that much more. Immediately the net added value per person will disappear and it will produce a 0 figure, because all of the rising cost will soak up the net added value or the net profit that these people can actually create. Now if we look at this from another angle, we start to ask the question, have we put in a good performance management system here? Because as soon as we have to start looking at net added value of 0, we need to look at each of these 3 employees and ask them the question, How can you add more value in this sales process? Now, in some organisations, this actually starts to create conflicts between the sales team because everybody starts to blame each other. The salesperson says to the phone canvasser, those leads you're getting me aren't very hot leads or warm leads. The phone canvasser turns around and says, you're just not very good at converting these to sales. And of course the fitter, who's struggling to fit windows within cost and on time, is going to say maybe the company's not charging enough for its products. So if you put the wrong sort of performance management system and you have the wrong culture where people are likely to blame each other rather than work with each other, then we're not going to have a performance system that actually helps the organisation move forward. The main lesson from this slide is that if we say to everybody involved in the organisation the only thing that matters is net added value to the organisation, and any performance measures we use have to be related to that, then in effect we pull everybody together behind that one single aim. Now the salesperson can't say they're doing a fantastic job if they achieve a lot of sales, if the net added value is zero. They all need to work together so they can agree on how to move forward in terms of improving value. The phone canvasser, for example, could work harder at getting warmer leads to do more sales appointments and also more conversions of sales for the salesperson. The salesperson could possibly start to look at how they choose which visits to do and maybe concentrate on the ones that are more likely to give them the sales volume they need. And the fitter, of course, has to look at ways of reducing the cost of fitting windows so they can get back down to some sort of profitable basis. This is a very simple version of what we might call an added value performance management system. In the classroom, I normally use the double glazing horrors example by taking 3 of the students in the room and saying, will you play the part of the phone canvasser, can you play the part of the salesperson, and can you play the part of the fitter? And I try to get them to really think inside the head of those individuals and think of it from a personal effort, the work they're going to have to do point of view. So for example, I often get the salesperson saying to the phone canvasser, hey, I need more sales calls, I need more sales visits, can't you get me more sales visits? And the canvasser turns around to the salesperson and says, I can get you as many as you like, but I don't think you're going to convert them into actual sales. This is almost a natural way that people behave. If they are put under pressure, they get defensive and they look at other people as being the cause of the problem. Now the real lesson of the double glazing horrors example is, if we fight each other, if we don't work together, we don't get value. In fact, a lot of the banks made this mistake by rewarding people for short-term gains and not thinking about long-term value. It is that crucial. So this question of value has now become the main issue here in performance measurement and management. If we're not measuring value, then we're not managing value. If we're measuring something less than value, then there is a strong possibility people will get defensive and work against each other rather than work with each other. So let's look at how we categorize the data and the measures we use for performance. Because actually some of these measures we use don't tell us very much, and it's only really the measures of value that we really want to look at in some detail. The more you delve into this subject of performance measurement and performance management, you tend to be brought back to asking some very simple questions about how organisations measure themselves. Now, to help you do this, all measures can be categorised according to 3 simple categories. Let's have a look at each in turn. First on the list are what we might call activity measures. Activity measures don't tell us anything about quality, output of the organisation, outcomes or results. So for example, measuring the number of visits that a salesperson makes just tells us that they are going through a certain activity of visiting a customer or a potential customer. It doesn't tell us that they've actually achieved anything from these visits. So we need to go to a different type of measure to answer that question. So we go to something that we actually call performance measures. A performance measure tells us when an individual is performing. So in the case of the salesperson, they achieve their volume of sales target. So if they need to sell €3,000 worth of double glazing, then they actually manage to do that on average. That's a performance measure. But that doesn't tell us the whole story. Of course not. What we need to do is move on to a higher level of measure called added value measures, which actually tells us not only that the company is making a profit from this double glazing, but the organisation as a whole is performing better. Value is a measure of everything in the organisation working well together. So when the company makes a profit on those sales and continues to do so, we can say that it's adding value. Now you might like to think what use this categorisation has in practice. Well, actually it's very, very simple. All you need to do is, when you are looking at measuring people and looking at the measures they use themselves to monitor their own performance, you can ask the simple question, are they really measuring the right things? Are they in effect just measuring their activities, which doesn't really tell us anything of any use? Are they at least telling us something about their performance? And a very simple indicator of a performance measure is you know which way you want it to go. Obviously you want profit to go up, and generally you want cost to come down. So a performance measure should at least indicate which way it should go. But the killer question for everybody is, are you adding value? Now any individual might say, I don't know, I can only do my job, and that immediately tells us how narrow their thinking is, and they are not thinking about the ultimate output of the organisation. So even asking this question gets people to rethink their whole view of what their performance really means. Spotting the difference between activity, performance and added value measures is an absolutely critical skill for a professional HR and learning person. So let us look at a whole series of different pieces of data that most organisations collect in one form or another, and ask ourselves the question, which of these fall into these three categories, and see what we can learn from this exercise. Here's one, number one on the list, the number of training days per employee per year. Many organisations set some sort of target, whether it's 5 days, 40 hours or whatever, for on average for their people to be on training. Now this is definitely an activity measure for lots of reasons. For a start, measuring the number of days somebody sits in a classroom doesn't actually tell us anything about whether they were trained. They may have sat there and not listened to what they were being taught. It certainly doesn't tell us anything about outcome or output. It doesn't tell us whether they applied what they were supposed to learn in the classroom, and it certainly doesn't tell us anything about value at the end of the day. So A would definitely be an activity measure. Yet many organisations continue to measure this, thinking it actually tells them something, but it tells them absolutely nothing. B, output per employee. In the car industry, this might be the number of cars produced per person per year. This generally would be a performance measure because we want it to go up. What it doesn't tell us though is whether we make any profit on those cars, so it wouldn't qualify as an added value measure. For HR teams, they're often asked to look at their recruitment costs or any of their costs, and they talk about things like average cost per hire or average recruitment cost. You might think this looks like a performance measure, that if the cost comes down, the HR department must be performing better, but it doesn't tell us that. Because if you were targeted on recruitment cost, it would be quite easy to reduce the recruitment cost. You'd do less advertising cheaper media. You could do less interviewing. So basically you could take a lot of cost out of the process and show that you've saved some money on recruitment. But if the quality of the people you bring into the organisation gets worse, you could hardly call that a performance improvement, and certainly not added value. Profit is probably the most obvious measure of value, although there is no such thing as a perfect measure of value, and even profit, as we all know, can be a figment of the imagination of accountants and the profit and loss account. But let us just take it that if an organisation wants to make a profit, and it is, then generally would regard this as a measure of value. Here's another HR specific measure, the amount the HR department spends per employee, or some organisations look at the number of HR people per 100 full-time employees. And let us say on average this is £100 average spend. This again is an activity measure because it doesn't tell us what they're actually doing in terms of managing or helping to manage employees in the organisation. And again, you could reduce the cost of this. Outsourcing and shared service centres are trying to reduce the cost of HR departments. But whether they've had any added value impact or even performance impact on the actual organisation itself, very rarely do people make that connection. Calls handled per hour, whether this is a call centre, whether it's an HR, shared service centre or whatever. Calls handled per hour would generally be an activity measure, but let us assume that the quality of these calls is monitored, then you might move to a performance measure. But again, there is no suggestion here that this will tell us anything about what the organisation produces at the end of the day. Sales margin, the difference basically between revenue and cost, is almost the definition the accountants use of added value. So this would definitely be an added value measure. Sales visits per day, this is a pure activity measure, although many sales directors would say there is a direct correlation between the number of sales visits and the amount of sales. There may well be a correlation, but it would be worth checking that. But it certainly isn't a causal relation that having more sales visits necessarily causes more sales. Sales volume, literally the number of cars sold or the number of products sold. Again, you'd probably want this to go up, so we'd probably call this a performance measure, but it doesn't tell us whether any profit is being made on this volume of sales. Staff turnover, probably one of the most problematic performance measures we're ever likely to collect, particularly in HR circles. I think the key here is to at least know what you're aiming for, whether 15% is a good or a bad figure in terms of your own plans. Customer satisfaction surveys hopefully tell us a great deal. The Balanced Business Scorecard puts a lot of emphasis on customer satisfaction, and if you're satisfying 95% of your customers, you could probably say this is an added value measure. It isn't quite, it's certainly a performance measure, but you could probably read across and say if we are keeping customers that happy, we can't be doing too much wrong. But maybe you still want to check whether you make any profit out of these customers. Rework hours, that's the time it takes to put something right that should have been right in the first place. All organisations have rework, and as soon as you start to measure it, any improvement is actually added value based on your baseline. Any saving in rework hours will go straight to the bottom line, but always obviously the target is to get rework hours to 0. This is an interesting one in education. The number of points achieved by somebody leaving the school system at 18 compared to what they entered into the last 2 years of school at 16. This is actually a measure called added value, certainly in the UK education system, because it tries to relate the initial 16-year-old's education attainment level with what they actually achieved 2 years later on. That is actually a measure of the added value that that school manages to bring to those students in those 2 years. A very powerful measure, and actually one that a lot of teachers are not very happy with because it really does gauge how well they are teaching their students. And here's another one from the public sector. Hospital bed usage, the average number of patients who go through a bed in a year. You have to ask yourself the question, why would we measure this? What sort of behaviour would this encourage in hospitals, in the nurses and the doctors? Would they be rushing to get patients in and out of the bed, almost regardless of whether they were ready to leave the hospital or not? So choosing the right measures is absolutely critical in getting the right behaviour from people in organisations. So we now know the difference between a pure activity measure, which just doesn't tell us anything worthwhile, a performance measure that at least points us in the right direction. You know, we want staff turnover maybe to come down, we want sales to go up. But the added value measure is one that encompasses everything in the organisation. Only if we all work together do we get value. Now, to create an organisation where everything's working together, part of that has to be a performance management system that looks at the whole rather than just individual or micro level. So let's look at a performance management system. Let's look at the building blocks that need to be in place to give you a fighting chance of producing a very effective performance management system, one that produces value at the end of the day. If you ask most organisations whether they have a performance management system, they'll probably say yes. But in practice, what you will find, these are often just procedures or policies or processes. In other words, a manager sits down on a 6-monthly or annual basis and discusses performance issues with each individual in their team. That in itself does not guarantee that we will get a performance improvement. The only thing that will aim to guarantee that is having a system. So let's have a look at some of the key building blocks of putting in place a performance management system. First on the list is actually to go back and look at the organisation and do a business-focused value analysis. Where are the areas in the business that we need to get more value from? Where are the greatest opportunities to get more value? This is a typical Pareto analysis of organisations and looking for the biggest opportunities to get quick wins. Then we can move on to actually measuring an individual's contribution to that. You cannot have performance management without performance measurement. It is a key principle of performance management systems. To do this, we need to review their performance with them, and often we may come up with some subjective measures of their performance. If we think somebody doesn't listen to customers enough, then we can actually measure that in a subjective way, but we will link it directly to the number of customers who give us repeat business, for example. So even if we're going to look at soft measures or skill measures, it should be directly linked to an output or a value in the organisation. Often, somebody's role will either help or hinder them in terms of their performance. In hospitals, if you ask the question, who takes blood samples and does blood tests? Now, years ago, this would have been done by a doctor or maybe a senior nurse trained to do this job. But actually it's a relatively straightforward task, and somebody at a more junior level could be trained to do this at a much lower cost. So asking a doctor to do it is a very expensive way of dealing with a very minor issue. So actually looking at the role is a key part of trying to get the most value out of each individual. And at the same time, we need to look at the systems, processes, and where the roles fit in the organisation as a whole. If the system demands that a doctor signs a piece of paper to say the blood test has been done correctly, then there's not much point changing the structure until you change the system as well. And the process would have to make sure that somebody is trained at a lower level to actually take this blood sample. I think in conclusion, we can take it that performance measurement and management has always been problematic. And despite the new attempts of balanced scorecards, EFQM models and various other approaches to performance measurement and management, if we don't make it a human performance management system, if people don't buy into it, then we're wasting our time. People will bypass the system. They will do things their way and then blame somebody else. So really, we need an HR strategy and a business strategy that creates an environment, a climate, a culture where people really want to perform, and they're not fighting against each other, they're working with each other on this to create as much value as possible.